welcome to the SIA Wealth Management presentation of Uncharted Waters Revisited. My name is Ted Bader, president of SIA Wealth. Thanks everyone for joining us today. I know there's a number of people that are still joining us, but I'm going to jump right into it. 6 months ago, we did a presentation called Uncharted Waters in October of 2021. It was one of our best attended and best feedback that we received from one of our webinars. A lot of advisors ended up using a lot of the content to talk to clients about risk in the markets. We did a high-level overview of kind of what we saw as a risk. I know the image that you're looking at right now shows this kind of doom and gloom and a big tidal wave, but the point is we want everyone to be aware of what the risks are in the market and how to guide through that. So what we're going to do is kind of revisit that, where we are with the risks that we highlighted 6 months ago and what we think is going to be the current environment, and looking forward, how you can prepare a bit for it. So the agenda is the storm has begun to a certain extent, what that means for your clients, and then we're here to also provide you a solution, which is true tactical, and we'll talk briefly about that. Before I jump right into it, there is a survey at the end of the presentation. I'm going to talk briefly. I'm going to introduce something that we've been working on here at SI Wealth. It's a tactical portfolio workshop. This is going to be rolled out in the next couple months, but we're going to give a bit of a teaser. It's about managing, helping manage, implementing tactical portfolios for your client segmentation book, and we'll talk a bit about that. So if there's any interest, please fill out the survey and we'll go from there, but I just wanted to give you a bit of a teaser on what we've been working on. This quote resonates for us, and it has for a while. Chris Hadfield, saying you must prepare for failure, not success. So an easier way to say it is obviously hope for the best, but prepare for the worst. And this is what we're talking about. We've had a very strong market situation over the last decade and a bit. Now, what happens when that doesn't continue? What happens when the Fed is tightening instead of easing? What happens when interest rates are rising? What happens when inflation is rising? And these are all situations that's happening today. So what do we do? How do we prepare for a worst case scenario or a breakdown in some of these pillars of the economy going forward? So this is what we're trying to do. It's not to scare anyone. It's not to be doom and gloom or thinking we're going to enter a bear market. It's what happens when those situations will arise. So this has always been quite important for us. It's to prepare for the failure or eventual breakdown of things and have a plan going forward. So 6 months ago, we highlighted we're in uncharted waters. There's a debt bubble with central banks, with housing to a certain extent. There's also a stock market bubble where market valuation was extremely high. So with the central banks, we were easing, now we're tightening. With housing, interest rates are rising, so house prices are still rising, but so are interest rates. So that will have an effect on it. Stock markets, the market valuation was at an all-time high, and it has weakened since then. And where will that lead to? So, and what's new is now we have conflict. So what does geopolitical conflict mean in terms of the economy? Well, economic sanctions do play quite a large role in that. So we're going to be talking a bit about that. Jumping right into it, central bank balance sheets have absolutely been in a bubble. So this has been since 2008. It's been central banks have exploded higher in order to prevent economic collapse. Many people thought this was not sustainable, but what is the end result? So now we're entering a tightening cycle. And what are the longer term implications of this? So this chart I always like to highlight because it really does show the amount of spending we've done. So the black dots are the financial crisis in 2008, the Great Recession, and the blue dot is the COVID-19 response. So as you can see, the Fed, central banks adding to their balance sheets has gone, parabolic. We all seen the charts that show it going through the roof. That has to be reined in somehow. That has to be tried to manage as much as possible. And now we have this bubble situation where you've printed lots of money, and that has given rise to inflation. So now we have to tighten it. And what are the long-term implications for our portfolios on that? So what does the end of easy money policy mean? This is kind of, we tried to pull some of these more recent highlights. Frankly, it's going to start with a higher debt servicing cost. And the big thing for markets is there's no more Fed put. So the Fed put, as many of you probably know, it's where the Fed would backstop the markets by creating liquidity. So print more dollars, put it into the market, and really the easiest way to think about it is quantitative easing was rocket fuel for stocks. So that happened, any type of situation, 2016, 2018, 2020, just print more money and increase the Fed balance sheet, and that would, respond. You see the response in the stock market. So what happened is inflation now has kind of reared its head and the Fed is now tightening. So what are the implications of this? You're going to have less liquidity, smaller central bank balance sheets, and now to battle inflation, you're going to see rising rates, which are bearish for long-term bonds. So the end of easy money policy is really going to affect all aspects, from housing to interest rates, to inflation, to stock market. So this is kind of, everyone has been expecting this to come, and we hope that the central banks will be not aggressive, but they'll stay the course, because you don't want to see another crisis where the Fed put comes into effect, because again, it just kicks the can down the road, which is what we've been doing since 2008, and I think everyone would agree on that. So this is what we have to deal with, and we'll try to deal with it as best a way as possible, but this is all impacting our current market environments, and this will impact what we're going to hold in the portfolios, absolutely. House price bubble. House prices in Canada, they've had a good quarter. They're going to continue to rise. As you can see, Canada is still the most expensive real estate, one of the most expensive real estate markets in the world. And I think it's one thing to have an expensive real estate house price, but what have Canadians done with that? Well, really what they've done is they've increased the debt load that they've taken on. So we were entering record levels of household debt. And after the 2020 crisis, we've resumed their climb. So really the house price bubble has allowed people to pull money out of their home, HELOCs. We have a much higher personal debt bubble and a much higher debt to equity ratio. And now that interest rates are rising, this is going to impact a lot of the consumers going forward. With a higher debt servicing cost, it's going to affect a generational transition, as we all have experienced. A lot of baby boomers are paying for down payments for their millennial children's housing. That is going to affect it, because now it won't be as easy to do these kind of things going forward. And it doesn't look to be stopping anytime soon. It looks like Canadians are going to keep on pulling equity out of their house and taking on more debt. So this is one of the byproducts of the housing market. Is the bubble is still, we can still have increase in house prices across Canada, but the really thing to worry about is how indebted are Canadians. And that's something to ask all of your clients is, are they taking debt out of their house, and what are they doing with it? So one of the biggest parts that we're all involved with here is stock market valuation. And we've noticed, everyone has a problem with market cap weighted indexes, and I'm going to highlight a couple of different points specifically in 2021. But I'm also going to talk to you about two types of bear markets. So one is price decline, obviously, but the second one is inflation erosion. And this is something that we need to be especially aware of going into the next few years, is how is inflation going to affect this? So first off, if I talk about market cap weighted indexes, is the market going up, down, or sideways? As you can see from the chart here, the blue line up at the top is the top 10 companies in the S&P 500, and the gray line at the bottom is the S&P 500. So what you're seeing is, yes, the S&P 500 has had a strong return since 2020, but really what you've seen is those 10 companies have driven the price up exponentially. In our indicators, we saw in May of 2021, we saw a weakening. We saw money start to leave equities and go to other safe havens. So we started to take risk off the table in May of 2021. That's because at SIA, we use equal weight indexes to do our analysis. So we were seeing broad-based weakening. However, as money continues to flow in, it was going towards these 5 or 10 companies that was pushing a market cap weighted index to new highs, all-time highs. So even though these other companies are starting to struggle a bit more, those 5 or 10 companies, and you see the names on the left here, they were continuing to hit new all-time highs. So now what we're seeing so far this year, in 2022, is those top 5 or 10 companies have started to weaken a bit. and kind of come back in line with what we were seeing from May of last year. And that's why some of our portfolios are positioned quite well. So the issue is we've had a sideways market. Basically, for if you were equal weighted, you've had a sideways market from May of last year for the last year, 12 months, and that could continue in the future. So is this going to be a growth environment of the last 5 years? A lot of people don't think so. Even if value starts to outperform growth, you might still see a sideways market based on the headwinds from less liquidity and from inflation as well. So this is the reality: is the market cap weighted index have made I guess a false security in market hitting all-time highs, and the reality is most of the companies in the S&P 500 have been going sideways for the last 12 months. This is an important aspect to think about, the inflationary bear market. Now, again, you could have a sideways market for the next year or 2 years, and that, clearly the market isn't going down, but it's not going up. So if you have a sideways market with inflation, it could be just as devastating to client portfolios as an actual market crash and price market. So what you kind of see here is a couple of different periods. We showed this 6 months ago, 66 to 82 and 2000, 2001. The actual return of the Dow was either flat or slightly negative, but inflation was rampant during those two periods. So your adjusted inflation return ended up being quite negative and very much impacting your client's portfolio. So an inflationary bear market is a real thing. We just haven't seen it in a while. And that's why a lot of people look at the 2000s as a lost decade. But now if we have inflation at the same level, this is definitely something to watch out for, and it is a huge risk going forward. So inflation is not going to be easy to keep under control, and it's just going to make central banks are going to continue to increase interest rates to try to keep it under control. But we've all seen the inflation numbers put out by the central banks. It's not going away. So you don't necessarily need a price decline in the stock market to experience a bear market. So this is something, again, we want everyone to be aware of. And it ties in again to the recent headlines, stock or the bond market is, look, geopolitical conflict has affected asset prices. The monetary tightening will affect the pricing and liquidity in the stocks. Rising rates are bearish for long-term bonds. So the big question is, where are you putting your client money? This is a problem because we've all relied on the Fed put for the last while. But what we're looking for now is it might be Powell may be selling calls, and the difference there is if we have any type of market growth, you might have the U.S., the central banks start to raise rates considerably because they have to catch up. They're behind the curve on this. So there's going to be a lot of turbulence. There's going to be a lot of volatility going forward. And again, one of the big questions that we're trying to help answer for clients is, where are you putting your client money? If bonds aren't a good option, if stocks are volatile, this is something that we all have to be looking for, and being tactical is more important than ever. We found this slide, which was very interesting because history doesn't repeat, but it does rhyme. So the last period that we had stagflation, where kind of markets went sideways and we had inflation going on, was oil, not bonds, was a return from 71 to 81. So energy stocks, REITs on the left, and then as you can see, corporate bonds and treasuries, 10-year treasuries on the right. I encourage everyone to look at what energy stocks did versus what 10-year treasuries did in Q1 of 2022 and see if this is the case. We don't know if this is going to be played out for the next little while, but this is kind of where you start to look at your history lessons and see what information can we take from the past to kind of dictate what we're looking for in the future. So it's an interesting slide about where to potentially allocate your money. So one of the questions, again, what was triggered? There was a lot of risk in the market. What was going to trigger that tsunami or potential changes? We had listed 6 months ago all these different points. And 6 months ago, the only one that was bolded was inflation. So what are the triggers to burst a double bubble? Inflation being the only one that was there 6 months ago. Since then, we've had 4 new points get added to this. So interest rate hikes and quantitative tightening has started. Armed conflict, which was, I didn't think we thought about that 6 months ago, but it's here. Public losing confidence in the financial system. This is something that, economic sanctions are being used as a weapon. So kicking Russia out of the SWIFT system, the rise of cryptocurrencies or alternative to the financial system, people lose confidence with it. The other one is a tax increase. So wealth taxes, US introducing a billionaire's tax. This is all a potential trigger of, losing confidence in existing forms of government, being punitive by increasing taxes and interest rates and quantitative tightening. So this is all another bunch of issues and triggers that potentially can lead us to closer to some of these worst case scenarios. Now, again, we could do a lot to fend this off, but we'd rather you prepare for a worst case scenario than anything. So why does this still matter to you? Because really, your target market is the baby boomer population. We did this 6 months ago. A lot of advisors kind of had an aha moment and understand that, yes, everyone knows that this is your target market. This is where the assets are, right? The reality is in the next 8 years, all baby boomers will be 65. They will be retirement age within the next 8 years. So over half of them are already retired and the rest of them will be retired by 2030. And baby boomer wealth is 12 times greater. So the question to ask yourself is, what percentage of your book is made up of baby boomers, and how are we going to manage that going forward? Because as they get older, they will be living longer. The expected rate of longevity is going to keep on increasing. We've seen it increase and it will continue to increase. And that means that you're going to have to help keep these clients' money lasting longer and trying to preserve capital, right? We move from growth into capital preservation as they hit retirement. So how would a bear market impact this? Where would your money go to? Traditionally, it went into bonds. That isn't looking like a likely scenario going forward. So as they live longer, then their client risk appetite decreases. So this is an example of showing, men and women risk appetite for as they get older. So in the 60 going closer to the 80 age group, they will not be looking at a time to increase risk. They will looking to decrease risk. And that again leads to a very difficult conversation about where you're going to put your asset classes. This was one of the most popular slides from 6 months ago, was the sequence of returns. And this was really powerful. And I think the message is still the same. As long as your client is not retired, so as long as there are no withdrawals taken out, and as long as you're contributing going forward, it doesn't matter if you have a negative year at the start or a negative year at the end. All we've done here is take this sequence of returns and then we've reversed it. So you have 3 of your strongest years at the beginning, when 3 of your weakest years at the end, and then on the bottom here you've had 3 of your weakest years at the beginning and 3 of your strongest years at the end. It doesn't matter the sequence of returns, as long as you're not taking out, you end up at the same point. Once you retire and you start withdrawing, that changes dramatically. If you have your strongest years at the beginning, you can end up ending up very positive at the end of it. But if you have any weakness at the beginning as well, you might deplete your retirement account. And this is a serious issue, because if you look over the last 3 years, 2019, 2020, and 21, you've had very strong double-digit returns in the market. So if you think we're going to continue to have strong double-digit returns in the market, this is fantastic. If you're worried that we can start having more volatility, more negative returns or single-digit returns, this could be a potential reality. So the capital preservation, the tactical asset allocation is going to be more important for any of your clients that are in retirement or very close to retirement. So this is an important aspect to think about, and this is kind of what we want to talk about. So kind of to sum up the whole thing of the Chris Hadfield prepare for failure, this is partly what we're talking about, is what is the worst case scenario? What do we need to prepare for? Well, over the next while, you do have the potential to have a bear market in stocks, which could be a price decline, or it could be an inflationary bear market. And you're already in a bear market for bonds. And why is this happening? Well, inflation is here and interest rates are rising. So we've talked about this for the last decade. Now these two situations are here right now. And to be fair, the likelihood of quantitative easing going forward has gone down significantly because inflation is here. That has not been the case for the last 12 years, but it is the case now. So the Fed and the central bank's ability to respond to any type of market emergency has decreased considerably. The worst case scenario is that inflation rises while asset values, stocks or houses, goes down. So again, the question that we're trying to answer is we want to present the case and then say, how do you prepare for this? This is where what we're trying to do makes a lot of sense. SIA Wealth and True Tactical Investing, why it matters now more than ever before, is True Tactical really is the means of using an unconstrained mandate that has a flexible asset allocation ranges between 0 and 100. At the end of the day, we are looking for non-correlation. We're trying to say when equities are falling, you want to be in, and I say bonds here, but really it's cash or cash equivalents, short-term bonds. And when bonds, when interest rates are rising, you want to be in some protected. You want to be capital preservation. So that's what we're looking for. That's what true tactical means. This is a question we ask all of the advisors we deal with. What is your tactical range? How fast can you move from a traditional 60-40 client portfolio down to 40-60, down to 30-70, down to 20-80, right? What is your client's expectation of this? If you have a tactical range that can move from 60-40 to 50-50, and it takes you 3 to 6 months to execute that, that's not really a huge tactical range. And this is where we've helped a lot of advisors improve and increase their tactical range. And that's something that they are then conveying to their clients and saying, look, when these types of risks present themselves, we have the ability to execute and move on this. So it's been really well responded from a lot of our clients. In action, this is kind of us putting our money where our mouth is. This is one of the mandates we run for BMO. It's our Tactical Global Equity Fund. And this is telling you that we do this. When we see risk in the markets, we actually execute and sell all of our equities and go to 100% fixed income. Now, when I say fixed income, it is more short-term fixed income and cash equivalents than any long bonds. But you saw it when our system goes from the green, yellow into the red zone, we will own 100% fixed income or short-term bonds. We did it again in 2020. We were out of the market. We got back into the market, and currently today, we only are in 45% equity. Our equity action call is in the yellow zone. We only have about 45% equity and 55% short-term bonds and cash at this point. So this is something that we've been able to manage. And so far in 2022, we've had a very, very strong performance. I'm going to highlight the Tactical Global Equity Fund a bit more in detail. But the call to action to do something to prepare for the risks that I've just laid out, if you believe that any of these risks is a possibility in the next 1 to 3 years, then the call to action is something that you should pay attention to. We are helping advisors automate their asset allocation by adding a 20% true tactical sleeve in their portfolios. That gives you the ability to take a client that's 60-40 down to 40-60 immediately. And this is what SIA Wealth does within the funds that we manage. We've been hearing a lot recently about alternative strategies. So this is trying to get uncorrelated strategies, such as we hear a lot about cryptocurrency, we hear a lot about real estate investing, and we hear a lot about private debt and private equity as well. So what you got to understand is that alternative strategies recently have becoming more and more correlated with equity markets. So I encourage you to look at any alternative strategies. Look at the last 6 to 12 months correlation to equity markets instead of looking at the last 5 to 10 years of correlation. Because what you want to see is what is the recent correlation doing? Because true correlation to equities is cash and bonds. That's the only one that's negatively that's the only asset class that's negatively correlated. So this is something to consider, is you can have a tactical strategy that will rotate away from equities during those periods of time. And finally, it's a complementary strategy. We do know that most of our portfolios are made up of long-only equity strategies, whether it's individual stocks, ETFs, or mutual funds, and adding a true tactical strategy really does complement a lot of this. I'm going to quickly highlight our BMO fund, and then I'm going to wrap it up so we don't take up too much time. But this is our BMO Tactical Global Equity Fund. As I mentioned, right now we're almost 56% cash, and these are the holdings that we have. So as you can see, we have exposure to some oil energy companies, base metals, oil and gas, bank indexes. We've had a very strong run, and I'm going to highlight the some of the performance number on Morningstar in a second. But as you can see, it's exactly what I said we were going to do. We're tactically managing the risk. This is one of the examples in Q1 of March 2020. As you all remember, the market started to decline. We were triggered to go to cash. We ended up selling all of our equities and holding up cash. We had a bit of a drawdown. Benchmark went down to a negative 24% on its lowest point. So this is a big difference. The problem is, and the difference is, back then, in the US alone, they did $3 trillion of stimulus spending to kickstart the economy. So they flooded the market with liquidity. You saw that bounce back, and that bear market lasted 6 weeks, not even. What happens the next time this situation happens and the Fed put isn't there? They can't push the liquidity into the market. They can't spend $3 trillion because inflation is already high and increasing. So this is the whole point. At this point, exactly when you want to be owning something that will get out of the way of those equity markets. And so far in 2022, it's been the same case. We've been managing the risk, so our drawdowns have been considerably less than the benchmarks, and our volatility has been considerably less. And that's one of the features of owning and why people are owning our funds today, because the Fed put is not as effective as it once was. So I'm going to pull up Morningstar here. I think you guys will be able to see this. And really, this is our Tactical Global Equity Fund. And if I scroll down to the trailing returns here and showing this, you can see it has been a first quartile fund for the last year. Returning the last 12 months has been a 10% return versus the market, which is just up half a point. And especially year to date, we're practically flat year to date when the benchmark is down, negative 8%. So this is important. Over the last 3 and 5 years of the fund, we're second quartile and been adding a lot of performance on this because we've been managing the risk on the downside. And to be fair, we haven't liked the Fed put. It hasn't been our friend, because every type of market situation where we try to get out, it gets bounced back because of the Fed put and liquidity and quantitative easing. So to match or to come close to benchmark returns over the 3 to 5 years is very strong, and especially to avoid the drawdowns that we've seen year to date, that's where the strength comes in. If you look at a risk return profile for this particular fund, this is exactly what you want in a current market environment. The risk versus your category is very low. We are a low risk manager, and our returns are average, so comparable to the rest of the category. As you can see here, we have a higher alpha, we have a better beta, our Sharpe ratio is better, and our standard deviation is better. So this is kind of all showing about the risk and volatility metrics of this fund relative to the category and the benchmarks. And what you get here is the upside. We're coming close to the category in the index, but really where we add significant value is on the downside risk. So what the category is doing is getting more downside risk than the index. We are getting far less. So as you can see here, we're giving you similar returns. The blue one is our fund, the yellow one is a category. Similar returns as the category, close to the index, but we're doing it with far less risk. And that's exactly, we've highlighted that there's a lot of risks going forward in the market. You want to have a tactical manager that will be able to understand those risks and manage them appropriately. So this is kind of what we're trying to do here. We've had a very strong year to date. We've had a very strong 1 year. This is the fund that we wanted to highlight for a lot of our clients who are asking about it. How do we manage risk going forward? We do have other funds with BMO, but this is the one that a lot of clients have been asking about. I will wrap it up now, but I'm going to mention that we have a survey at the end of it, and kind of a little teaser is we are going to be launching in the next couple months an SIA Wealth Tactical Portfolio Workshop. And the reason we're doing this is because we're trying to help advisors. Advisors use SIA to create stock models, ETF models, mutual fund models. But what we're trying to do is help you develop a client segmentation model to streamline your practice and allow you to be tactical without having to trade a lot. So the whole point of this is we've created robust online portfolio construction tools, analytics reports similar to Morningstar to stress test different models. And the whole point is we're ensuring your portfolio complies with your new know your product rules. So we'll be able to have a history and a record of your holdings, show what you purchased, and an objective analysis process that your compliance departments are looking for more and more. So we're trying to make tactical practical. That's going to be our tagline. But the point is we're going to allow you to kind of create a tactical portfolio model with analysis, know your product guidelines and rules, and allow you to understand what that all means. So this is going to be coming out. The survey is going to ask you if you are interested in some of these things. So if you are interested in this workshop that I mentioned, please answer the survey questions, and we'll be in touch over the next few weeks. But I just wanted to kind of highlight what it is we're talking about is the storm has begun. We're seeing inflation rising. We're seeing interest rates rising. We're seeing how we respond to this. But the reality is a lot of the central banks do not have a lot of wiggle room. Interest rates at historic lows. The amount of liquidity that's been pumped into the market, there's not a lot of opportunity to change this. So we have to ride this out for a bit, and there could be a lot of negative impacts. So being tactical, being able to move your portfolios is important at this point more than ever before in the last 10 years. So thank you all for joining us. I don't want to be doom and gloom. There are a lot of opportunities going forward, but you have to plan for that. You have to plan for the worst and hope for the best. And that's all we're trying to do here. So feel free to reach out to anyone at SIA. If you want to talk to anyone at BMO about the BMO funds, feel free to reach out to anyone there. Thank you very much. And we look forward to working with all of you in the future. Take care and have a great day.